Alice.
What's that? Zoom.
Yeah, I already got that. Better.
We'll start in about 5 minutes. I thought we'd have more people here. Maybe they're late or maybe they're not coming. I don't know.
It's a holiday week.
What holiday?
Well, Easter, the kids were out of school in PV last week, and I think the Torrance babies are out this week
Uh-huh.
on their little vacations, their little breaks. Yeah, there's a lot of dates, holidays.
It's still a week and a half away.
A lot of
Yeah,
schools are doing it earlier, a lot of spring breaks.
yeah, they want to make sure that it's not associated with the holiday. You know, because so nobody gets mad. Yes, they do it. It's a constitutional issue, unfortunately. But somebody got pissed enough and they changed it. Yeah.
Yeah, it was for me too.
Mhm. It was so much easier when it was easy. You knew every time.
Yeah, because LAUSD was out, I think, last week. I think they were. They
Oh, yeah.
usually-
When was LA? Would you know?
Oh,
I mean, I know she just got out of that.
Just finally.
Yeah, she just finished that.
But they used to be
2 years ago.
the week before that Sunday of Easter.
Right.
And I remember Long Beach, Compton Unified, all the others was a week after Easter. So I don't know.
So it was still abutted on one end or another by Easter, you know,
And
by
not
Resurrection Day, yeah. But now they're like, get away from that, you know.
Hey, what is this thing in the middle? This gray thing?
I always wondered about that. I think it's an alien tracking device, so I'm not touching it. Yeah.
It's a Zoom word. And it follows
Just show us.
whoever's talking.
Oh.
It goes, zooms in on them and it goes around.
I see.
Mhm.
Now that I know that, I'm
Mhm.
starting up. Okay.
That's interesting. Okay, well, let's start. I don't know that we're gonna have more attendees or not. I'm very disappointed, but I'm pleased all of you are here. Okay, first of all, how's business?
Unbelievable. That's what we're supposed to say.
Well, is it? For real?
Oh, yeah. We're making it unbelievable
Okay,
in process.
well, I'm gonna talk about real estate to some extent, but mostly what Dirk wanted me to talk about was our business, investments and so on.
Sure.
For your retirement accounts, et cetera. I guess he's concerned that you guys plan properly at what. So I made an agenda. I don't know if any of you saw it about what I wanted to cover. Apparently you didn't. Hey, Dirk, can I get a half a dozen copies of this somehow? I guess. Would you-
We can pass it around and hug trees.
Just one side?
Yeah, yeah. Thank you. But hopefully, you have all participated in some sort of a retirement account or another, whether it be an IRA, a SEP IRA, a 401k, 403b, whatever. Or just your own non-retirement accounts, personal accounts. And I'll talk about those things. Thanks. And I need one back. I need this.
Bottom one's the original.
One more.
Thank you.
Thank you.
Thanks, a separate.
Thank you.
For that Peter bread. That's so good.
Okay, in investing, the core principle that everyone must know, what do you think that is? Now, Warren Buffett makes a big deal out of this, but what do you think that is?
Save money.
Don't lose money. He says there are only two rules you need to know to be a successful investor. Rule number one is don't lose money. Rule number two is see rule number one. Don't lose money.
Nice.
And so you want to protect against losses. And a lot of people, have pie in the sky about their growth, but steady as you go, if you don't go backwards, you're likely to end up beating all the hot shots that go up and down and up and down. So capital preservation is the main priority for almost any investor. Just be more prudent. The great American economy will take care of you if you don't get reckless. All right, then the biggest mistakes that investors tend to make. There are a number of them, but first of all, in most portfolios, there are just too many holdings. I know we've been preached to diversify, but you can overdo a good thing. And again, using Buffett, and I only use Buffett because he's good with sound bites and he's good with investing. He's the best investor of our time. But he says diversification under chaos, broad diversification, really is for those who don't know what they're doing. Now, I have another cynical point of view about that. I think a lot of brokers over diversify so that you'll think you need them. They try and make a simple thing complicated, more complicated than it should be. But too many holdings, you can't track any of them. Be picky, selective of what you invest in. Don't just throw stuff against the wall. The second big mistake is a portfolio that is not compatible with your goals and objectives. Like, I often see people who are in retirement or near retirement or whatever, who really are investing like they're a 20-year-old with very little money and have nothing to lose, so they might as well just go for it. I mean, it's just too aggressive a lot of times. I mean, as you get closer to retirement, honestly, this is it. You just don't have time to screw this up. You got to be more careful. Especially, this is true of women statistically. Too much money in cash. Cash returns, no return today. If you have money in bank accounts, money market accounts, stable value accounts, you're getting no return on that money. Women particularly are the biggest culprits of this. So there is, as we know, women in the corporate world have an income gap. They don't make the same wages that men in similar jobs. Well, there's an even bigger investment gap where women don't earn from their investments nearly as much as most men because they keep too damn much money idle, parked. A parked car is safe. It's unlikely to be wrecked, but it's also never to get to a destination. It doesn't move. And that's what money in a bank or money markets or whatever amounts to. So if that's you, you really would be wise to address that. And then, as I said, don't make a difficult thing, don't make an easy thing difficult. Don't overdo it. Another big mistake is not writing down what you're trying to accomplish, your goals and objectives, and what your portfolio looks like. I know you get statements from brokers, etc. Here's our agenda. We're on the second point. I know you get statements from brokers and so on, but are you really analyzing that properly? Like, what is the percentage where? For example, we frequently see portfolios where people will have 35% in one holding and 0.3% in another holding and 2%. And I mean, it's all over the board. There's no order or organization to it. And that just doesn't make any sense. I mean, if you have 2% of your money in something, honestly, it cannot move the needle. There's just no point to it. It's a waste of your energy. So do your homework or have someone do it on your behalf and make meaningful positions. Now that's the same in real estate. I mean, you have to, in real estate, take a meaningful position. You can't just buy 1/8 of a house, as far as I know. I mean, you have to take a meaningful position. So you do your homework before making a real estate investment, and you make a wise and well thought through decision. You really contemplate it. You just don't throw something against the wall and hope it sticks. One of the things that's kind of interesting to me is I think we're experiencing and will continue to experience a difficult time in our economy. we are probably in the first real economic shift in approximately 30 years. The last 30 years have been about declining interest rates. It's been about declining inflation. It's been about available cheap labor, both domestically and abroad. That's all gone. You can't get employees. Interest rates are rising. Inflation is rising. It's also been about, we started 30 years ago with essentially no debt. And when Bill Clinton left office, one of the concerns of the Federal Reserve Board is we may have no debt. So how do you get a credit rating if you have no debt? You all know about that, right? So there was, hi Caroline, come on, have a seat. So there was concern, and you come down here, you're gonna have to work with Chuck anyway. Come on down here. Caroline and I work together, as you all probably know.
Do you want to sit down here?
Yeah. But if you have no debt, you have no credit rating. So there was actually concern when Clinton left office, we would have no debt. Well, that meant that the government was free to be very stimulative. Well, now we have debt coming out of our ears. So, that's going to hamper them at some point in time. It hasn't thus far, but it likely will. And where we're beginning to see some of the hampering is the increase in inflation, increase in interest rates. That's not a coincidence. So this is a really seismic shift that we're going through, and you're at the beginning of a new economic era, or the beginning of the end of the old economic era. And so I think you really have to address that in both your business, and I'll talk about your business relative to these thoughts, and in the world of your investments. So again, Warren Buffett says, it's only when the tide goes out that you see who's swimming naked. And that is very wise. It's only in down markets that you see who's screwed up. In a rising market, everybody's a genius, whether it's real estate or our business. In a rising market, you can't make a mistake. But in a difficult market, they all get exposed. Everything gets exposed, right? First of all, everybody goes to jail who have been cheating, and everybody gets losses if they're exposed, if they haven't been reasonable. In a period of inflation, and it's here. In a period of inflation, one of the keys for investing is there must be price elasticity, the ability to raise prices to keep up with that inflation. So there's very little price elasticity when it comes to things like steel. There's a lot of price elasticity when it comes to gasoline. You got to have it. There's a lot of price elasticity when it comes to Coca-Cola. Coca-Cola is really, or any kind of soft drink, is really remarkable. How much does Coke cost? Tell me, what do you think Coca-Cola costs?
Less than a cent.
I can literally tell you.
Less than a penny. Yeah, less
No,
than a penny.
to buy, not to make, to buy.
Oh.
Yeah, I was like, what size?
Like a dollar?
Let me tell you about price elasticity. Go down to now the crypto stadium used to be Staples. It's $8. Go down to Mexico, it's probably 50 cents. I don't really know. I haven't been to Mexico. Go to Thailand, it's probably a quarter. I mean, there's price elasticity. They can charge anywhere from $12 to nothing.
Yeah, for the same thing.
Yeah, I mean, so they can, if there's inflation, they can pop that price 25 cents. Who's gonna care? You think your kid's gonna say, oh, yeah, don't buy me that? It's not happening, right? Cigarettes have price elasticity. If you're a smoker, you've gotta have it.
Yeah.
Right? $10 a pack. I mean, I'm blown away what cigarettes cost. I used to smoke, and when I stopped smoking,
Retail.
they were 60 cents a pack. I don't know what they are now, but I
They
think
were
they're like,
$1.25 for me. They're like $7.
I think it's more than that.
Something like that.
Yeah, I mean, that, now fewer people are smoking, but that's price elasticity. They can charge it, and if you're addicted, what can I tell you? You're gonna pay. So you want things that have price elasticity to keep up with inflation. Now let's go to your industry. Your industry has that. You'll be able to keep up with inflation because as your percentage commissions, and actually in my time, I think they've come down, right?
Right.
What is the percentage typically now?
So the average is 5. It
Five,
used to be 6.
And I thought it used to be 7 at one point. Am I too
No,
high?
it was 6 here for 40, 50 years.
Okay, all right, so I'm mistaken. All right. Now, that is not 1%. It came down 16 and 2/3, essentially 17%. In other words, 1% is 17% of 6. That's a big pay cut, but the value of the house went from $100,000 to $1 million. So you had price elasticity, your commissions more than kept up, right? And then one of the things, I'm just telling you this as an aside, but as a realtor, you should really be aware, your real commission is 30%. Here's why. Somebody's gonna buy $1 million house, how much are they typically gonna put down? 200,000, 20%? Yes, 20%? Okay, so that's all they actually spent. They borrowed the rest, and they're paying interest on that borrowed money. So the money they spent, you got, what is 6% of $1 million? You got $60,000. That's 30% of the 200 they actually put up.
Yeah.
I mean, right?
Yeah.
So you guys really have a pretty good business. You get a 30% commission on most houses. Well, not all, some people pay cash and stuff.
With the cash,
Yeah, of the cash they actually put up. Without that ability to borrow, they wouldn't be able to buy those houses. So I think that you have to be mindful of that. All right, then in retirement or near retirement, particularly in an inflationary environment, you have to make sure your money lasts in retirement. There's longevity, especially again for women. Not entirely. Well, Thursday, Friday. I'm just using air traffic, by the way. And let me, will you pass this to her? We are on the third point, how to make your money last in retirement. But the fact of the matter is the biggest concern for most Americans near or in retirement, and especially for women, is that they run out of money because of longevity. It's interesting that a financial company, and I think it was MetLife, I think that's who did the survey. They did a survey of women who earn over $200,000 a year. That's a pretty darn good income. The greatest fear is that be bag ladies. And these are powerful women. These aren't somebody who's just limping along. Their greatest fear. It was shocking in the survey. Everybody was stunned, like, really? 200,000 plus women are worried about being bag ladies? So the biggest concern because of longevity is outliving your money. One of the second biggest concerns is long-term care, which also because of outliving your money.
We already answered that.
And again, especially for women, because you women tend to be the caretaker. You're gonna take care of your parents, you're gonna take care of your spouses. Your spouse is not gonna take care, you're even gonna take care of his parents. And from statistically, he ain't doing nothing. He's feeling bad for you. That's it. All right, and maybe he'll buy you a rose once in a while, but he's not doing it.
no comment.
I'm being quiet. I'm just.
So you women are the caretaker, but the question is, who's going to caretake for you? Especially if you don't have daughters, because your sons aren't. They may send some money, but they're not.
With my son.
Well, some sons, but on the whole,
Yes.
on the whole, it ain't gonna happen.
They look to his daughter-in-laws.
Daughter-in-laws, yeah. But you know, that's dicey. Sometimes, well, I mean, sometimes it's not good chemistry.
That's right.
You know, sometimes it's not good chemistry. Sometimes it is. You know, in my family, we all had good chemistry with all the in-laws, but that's, you know, I know families where that's not the case. That's just not the case.
No, and the life is different. I mean, you know, our kids, the ones born here in California, for them to afford a starting home
It's
to
hard,
begin with,
yeah.
then you have two people working.
Right.
You used to have that, my mom thought, and then I had that, you know, I got married and my husband worked and I stayed in the house.
Right.
That's not gonna happen for my kids.
And also kids move away. Maybe not as much from California as other places, But, I'm from Pennsylvania, kids move away.
Yeah.
And some do from here too. Actually, I was just talking to a client, Dennis Hill. His daughters moved to Oregon because of jobs. So, they moved away. It does happen, even in a desirable location, let alone in a less desirable location like the Rust Belt or the Snow Belt, or whatever you want to call it. So how do you guarantee that you won't run out of money? Well, there are certain guaranteed investments. One is Social Security. And everybody asks, will Social Security be there? Get over it. It's going to be there. They haven't printed this. Don't even give that another second thought. It's going to be there. Another is pensions if you have one, but fewer and fewer and fewer people have pension. If you're in real estate, you don't have a pension. If you had a previous job, you may or may not. But in real estate, you don't. You have to provide for yourself with your SEP IRAs and things like that. Also, annuities provide a guaranteed lifetime income that you cannot outlive. A lot of people have an aversion to annuities because they don't understand them. Usually the aversion is very stupid. Annuities really have a place in most portfolios, particularly for those near. And then life insurance has a place. Now, let me tell you how life insurance has a place. I want to make sure that if I predecease my wife, and statistically I will, men don't live as long as women, and she's a couple of years younger than me. So she's probably going to outlive me. Maybe not, but probably. Probabilities statistically are she'll outlive me. I want her to be, I don't really give a damn about the kids as much. I do, but you know what I'm saying. I mean, everybody talks about, well, will your children get an inheritance? I don't give a damn about the children. They're on their own. I want to take care of the woman I've been sleeping with all these damn years. So one of the ways to do that is if we're going to spend money to live a rich life, meaningful life, I have an insurance policy. So when I drop dead, she's covered. Now, if she dies before me, when I drop dead, my kids get it. It's not the end of the world to me. I mean, I like my kids. And I even like, mainly I like them because they're the keeper of the grandkids. I like them even better. But the reality is life insurance is a fairly inexpensive way to secure that death of one. And I think people overlook that. And you can get life insurance generally pretty affordable if you have good health, up to about age 79. So a lot of people say, oh, I'm too old for it. Well, maybe, but you ought to price it. And you ought to price through us, by the way, but you ought to price it, whether it's through us or somebody else. And make an informed decision, is this for you? And the price helps that decision. If the price is pretty inexpensive, you'll probably do it. If it's costly, now you really have to think about it or reject it. I mean, I get that. But do the homework. Don't just make frivolous yes and no decisions, which I started with to begin with. Don't just do willy-nilly. Think through what you're doing. Now, when women do get invested instead of just cash, historically, they tend to do better than men. One of the reasons is they will ask directions. Men oftentimes don't. It's like the old jokes before you had GPS, is women will ask directions and men will just flounder around, know-it-alls. And so women can succeed as investors because they do ask directions of professionals. And again, hopefully those professionals will be Caroline and me and our firm, but somebody, if not us. I mean, I want everybody in California as our client, but that ain't going to happen. I got that. I've come to grips with that. It kind of bugs me, but okay. Okay. Let's talk about what are the chances of a recession. So there are a couple of major barometers to make a judgment about, and they are at odds against each other right now. Historically, all recessions are a byproduct of too much inventory. Whenever there's an excess inventory of almost anything, people will stop producing, lay off, cut back until they can sell that inventory, right? So if you had an enormous inventory of houses and no buyers, not enough buyers, it would be a problem. It would be a real problem. So usually recessions are a byproduct of too much inventory. We have no inventory. You can't find a house, you can't find a car, you can't get ships, you can't find employees, you can't get a ticket to a ball game. I mean, there's no inventory of anything. I wrote some of these down. What else? Sheriff just came through for me. You may or may not recall when I was here before, I said I can't get coffee cups. I mean, I couldn't get them. And then 2-3 days after I was here and talked about that, there was a front page article in the Wall Street Journal. Nobody can get coffee cups. I was very cutting edge with that. They said even Starbucks can't get coffee cups. So now Starbucks has a program that they hope to implement fully within the next 2 years. You bring your own cup. And fill it. Yeah. Now, Derv recently told me just as I came in, went and bought coffee cups for me at Costco because they're back. But I told them last week, I went to the office and said, they're back. I bought a box too. So now I'm overloaded with cups. But thank you.
You're ready for the next pandemic.
Yeah, that's right. But you know, you can't get into a good restaurant. I mean, there's no inventory. So that belies the notion of a recession. On the other hand, the other clear barometer of a recession is rising interest rates, rising inflation. The United States has never been able to bring inflation down without a recession so far in our history. So far, maybe this Federal Reserve Board chairman will make a soft landing, but a lot of people are skeptical because our history says we haven't been able to do it in the past. Now, I hope that we're getting smarter, but we haven't been able to do it in the past. And
to touch on that, you know, we lived through that era where the inflation was so high, they kept raising interest rates. 18%.
No, 21 3/4 was the high water.
Yeah, I mean, that banks actually would not even lend.
18%
With
for
mid
mortgage.
80s, early 80s.
But the inflation was so
Early
high.
80s,
So, yeah.
late 70s, early 80s.
Yeah,
So
the-
that transition.
Yeah.
The inflation was so high, and I still remember this. I had a friend that was an engineer, and we we're looking to buy some investment properties. You know, everything was 15 to 20% a year. He did all these calculations, being an engineer, and he says, you know, the only way I could lose money on this is if inflation was less than 5 or 6%. And we both laughed. Because like, that would never happen.
Well,
And sure enough.
when I first met you, Derv, which was quite a long time ago now, right? Probably what, 12, 15 years?
Yeah,
Somewhere around there. My brother-in-law, who's a physician, wonderful, wonderful guy, dumber than a brick about investing. Physicians are the worst investors on aggregate of all professions. Their spouses are among the best. Spouse knows, especially in the older generation, like it was mostly a male physician, woman spouse. Nowadays that's shifted. There are a lot more women physicians. But the spouse knew that the SOB was going to leave her, either a divorce or die before. So they were better investors. Second worst, this is a point of information, is a tie between CPAs, accountants, and engineers. They're the second worst. They want to study it further. They only buy when everything's
Oh
hot,
my God.
after it's gone up. They're a disaster. So when people say, I'm going to talk to my accountant, it's like, oh my word, we'll be here forever. Nothing will ever happen. They can't make a decision. But nonetheless, my brother-in-law, who's a physician, I kept telling him, and then when I moved here in 1990, I kept telling him, do a variable, because he was refinancing. And for us, he's our client. For us, it was a nightmare because you got to produce all the documentation of all their investments. I kept telling him, just get a variable. Oh no, they're going to go back up. Oh no, they're going to go back up. And throughout your career, you've been saying, oh no, they're going to go back up. One of the things that fascinates me, the three things that everybody in every real estate office I ever spoke to, and again, I think you'll subscribe, that everybody believed in their heart and soul is taxes will go up, inflation will go up, interest rates will go up. All three collapsed. Well, now I'm telling you that inflation and interest rates are going up. And this is a real departure for us. This is a 30-year cycle that is shifting. It's not subtle, it's profound.
So I've been taught that the interest rates it's a factor of that Fed rate. And isn't the Fed rate still in that 1.5%, 2%, that money? that
Yeah,
banks
but they're
borrow?
they're talking about bumping it another half in May,
Okay,
and they're talking about 6 more bumps.
yeah, but they haven't really bumped it a lot.
No, but they're behind the
Relative.
curve on inflation. They're behind.
Yeah, but relative to interest rates, and I was always taught that there's typically like a 2% spread between that Fed rate and the 10-year treasury or a 30-year loan for banks to make money. And I know, because we talked about this, that it's been more than that, because it was down to 0.5% for the Fed rate, and rates at 3% or 3.5%, banks were making lots of money. But now it seems like it's gotten crazy in that we're still at 1.5%, but we're up to 5%.
Yeah, but the 1.5 will go up. Everybody, it's a lag.
Okay.
They're gonna go up. The Fed's promising. So.
But what's it gonna go up? 2, 2.5, 3?
I think more.
Oh, okay.
I think more.
Okay, and therefore the interest rates you think could get up to 6, 7%?
I think they could get to 5.5, 6, maybe. I hope not. I hope I'm wrong, and I hope they engineer a soft landing, but I'm skeptical.
Yeah.
Now, why? I'll tell you some of the reasons why, but it doesn't matter to you in your industry. In a period of inflation, what you want are tangibles. What goes up? Tangibles. Gold, silver, diamonds, artwork, real estate. So whenever mortgages were at 18%, if you could get financing, you still did okay. You still did okay. What caused, and I talked about this when I was here before, what caused the last 2 real estate crashes over the last 30 years, which would have been in the 08 and in the early 90s?
Yeah.
Wasn't real estate. It just wasn't. It was the banks. You couldn't get money. You're in a capital intense industry. You need borrowed money. And when the bank shuts you down, that was the end of it. It wasn't real estate. Right now, the banks are healthy. And whenever interest rates were 18%, the banks were healthy because they were pumping it out there at 18%. So real estate did okay. And the banks are healthy. So the only time you have to worry about a crash in real estate, particularly in a desirable area, a crash, prices will go up less than they have been. But, I mean, you know that. I mean, they've been ridiculous of late. I mean, they're probably even flat now. But they're not going to crash unless the banks stop lending. And if they stop lending, somebody's going to send you a memo. It's called the front page of the newspaper. I mean, you'll know that, right? And really, it will probably bring supply and demand into a little bit better balance where you might get a little more inventory. Who knows? Who knows? But you're in on a little secret. Most people think if interest rates go up, real estate won't do well. I think most people think that. They're wrong. Historically, they're wrong. The only time real estate, particularly in a desirable area, you're not living in Buffalo, New York, I get that, is if the banks stop lending. Then it's over. I mean, if you can't get money, it's the end of it. But we're not in that boat. So I think the chances of a recession are rather good because of an inverted yield curve. An inverted yield curve means when short rates are higher than long rates. If short-term interest rates are higher than long-term interest rates, you got to be foolish, just foolish. You're going to stop borrowing because it doesn't make any sense to borrow long-term to build a factory or to hire people or whatever. It just doesn't. So you're going to stop it. And that's a real telltale sign of recession. And you got everybody in the world debating, well, is it going to happen this time? The answer is yes. I mean, the world doesn't change. Things stay as they are. So the answer is yes. So I think that you have a better than 50-50 chance of a recession. Now, when? Maybe not this year because there's a lag time. The Fed raises rates, that's the short rate. You probably have a lag time, but I don't know when, but I think you can pretty well count on it. I think there's a greater probability of yes, a recession versus no recession.
So our lender was telling us yesterday at our office meeting that the stuff he was reading was suggesting maybe a recession next year also. And with that, lower interest rates.
I don't think so.
You don't think that the feds will ease up on their,
I don't think so. I really don't think so. I think that they'll welcome a recession. I hope it's fairly mild.
okay.
Okay, but they always push it out. Everything I read says next year. I don't believe them for a second. I think they just try and give you hope. But maybe they're right. I mean, nobody has a crystal ball. I don't purport to be 100% right on timing. I think we've been pretty darn good on direction and historically. And I think you'd agree with that.
Yes.
Yeah. But I don't see the Fed getting a soft landing. One of the problems is there aren't enough employees. That means they got to get raises. And if everybody gets the cycle of raises, you're compounding the inflationary cycle. And there's not going to be enough employees. We have shut down immigration as much as we can. Nobody's giving birth. We have the lowest birth rate, even lower than the Great Depression of the 1930s.
It's because I stopped.
Nobody's having kids. What's that?
I finally stopped, that's why.
Yeah.
Yeah.
How many do you have?
4 that I know of, yeah.
Well, you would know.
I don't know.
No, but it's true. I article about 2040. I mean, you're talking about
Yeah.
1.1 kids.
No
per-
kids.
Yeah,
Okay.
there's no kids.
Well, and they say that Italy and Japan may not actually be viable countries by 2050.
My
Yes.
kids don't want kids and they're already adults.
They never- nobody-
They don't
yeah,
want-
no
no,
kids.
I don't want
Yeah,
grandkids.
no
I'm done. Yeah.
Even
Got
China is suffering for their 1 kid policy.
Yeah,
in
they're
like
trying to get it back to
2050.
2, but nobody's going for it.
2050.
But, I tell all these women, you think those Italian guys were sexy and all that, they're not doing anything
I wouldn't
about it.
do very much.
I mean, and there's an article in the New Yorker, I have not yet read it. I just got the magazine last night.
Nice.
But the article is, whatever happened to sex? Nobody's having kids. And we're not taking immigrants. If you don't have labor, you can't have productivity. If you don't have productivity, it's all inflation.
Yeah.
So we got some problems there.
Well, no matter what, if the population diminishing is, we're slowing down, allowing
Slowest
people
growth
to
ever.
come in here, then those are people who are also having babies, people that come from other countries, but we're not letting them in. So
Not
no more
enough, not
babies.
letting them in and not enough of them.
Handmaid's Tale.
So we're not getting a labor force.
So what's your theory on lower inflation then? If, when we look back to where they were raising interest rates, we were still keeping behind inflation and it really didn't help that much, right?
Ultimately, it did. They raised them
Yeah,
enough.
but took, what,
They-
10 years or?
Yeah, well, no. Volcker started to do it. It took them 2 years. Before Volcker, they were still stimulating. It was ridiculous.
Okay.
Burns was the worst Federal Reserve Board
So
chairman.
you think within like a 2-year period of?
Oh, yeah, I think they
increased
can
rates-
remedy it, but they remedy it with a lot of pain.
Yeah.
It's painful. It was very painful. It was very painful. But they remedied it by raising interest rates, lowering taxes. Reagan lowered taxes. Volcker raised interest rates during the Reagan administration. It was a double whammy. And also Reagan closed a lot of egregious loopholes that were just wasteful. So, but it was very painful, very painful. I don't think this would be nearly as pronounced. From the Nixon administration to the Reagan administration, we lived in a nightmare. They were dumb, dumber, and dumbest.
We were just
I mean, they just did everything wrong. But I think the Fed has really learned a lot. I think we're smarter. So I don't think it'll get to be that severe. I hope I'm right. But the big 3 to be concerned with is inflation, interest, and one easy barometer to judge those is oil prices. And you see that. I mean, gas is preposterous. It's preposterous. And I don't think they're going to come down anytime soon.
You don't have to.
I just don't think they will. I think that oil supplies are small and we've got this war going on. Lord knows how long it'll last and how difficult it'll be. I don't see it. And, I'd love to be wrong. Okay, so in a recession, Stocks not so good, bonds terrible, because when interest rates go up, the value of bonds goes down. So if you have a bond mutual fund, get the hell out of it, get the hell out of it. Stop screwing around and hoping against hope. You're gonna blow it. What does well? Real estate and annuities, that's what does well. Period. And bank accounts, but don't keep, it's still low interest, so don't keep too much there. But, bank account interest rates should pop a little bit. Instead of getting 1/4 or 1%, you might actually get 1%. Yahoo. Now you're seeing signs of this. A lot of people think the last couple of years have been good for the market. They have not been. Before the pandemic, in February of 2020, the Dow Jones Industrial Average was at 35,400. It is now at 34,900. It's down 3%. Now, if you bought at the bottom of the pandemic, 18.6, you did well, but nobody did that. You all freaked out and sold. What the hell are you kidding? I mean, if you did that, you'll be famous. You didn't do it. So the reality is you probably haven't made any money in the last 2 years. I damn well know it. If you had real estate or an annuity, you did. So these edges have been cratering for more than just the last couple of weeks, whittling away at it. So in the last couple of years, you've had a lot of activity, but no economic progress to speak of. A lot of activity, a lot of churning, not much progress. I want to show you some statistics. Caroline, could you man this thing? What most of you own if you have retirement accounts, or if your friends have 401ks or IRAs, you own these things that are called target date funds. That is the most widely held category of mutual funds in retirement accounts, by far, by far. So let's go to the S&P 500 full screen. A picture's worth 1,000 words. That's why we're doing this. Go to 5 years. 5 years. You're on 5 years.
5 years.
Yeah. Okay. This line is the Standard & Poor's 500 index over the last 5 years. And you can see the big dip there, right? Now let's go to some of these target date funds. This is Vanguard, VTTVX. This is a Vanguard target date 2025 fund. I guarantee some of you have this fund in your portfolio. In the last 5 years, the market is up 91%, that fund's up 11%. That's pathetic. And notice it went down every bit as much during the pandemic. So you didn't have any downward protection, but you have no upward kick. Now let's go, and everybody, your broker tells you, well, diversify. Don't just do the 2025. Let's do a little bit of the 2030, which is VTHRX. VTHRX. Let's see how well diversification is served. It's nonsense. There's no real difference. Let's go to 2035, VTTHX. And these are Vanguard funds. They're among the better ones because they have low cost, right? Same to me. Let's go to the next one, 2040, VFORX. Looks the same to me. Terrible. Now go to 2 years. This is 5 years. Let's look at 2 years. In the last 2 years, they all got clobbered. Let's go to year to date. Year to date, they're below the S&P. Let's go to 6 months. They're getting killed. Just killed. Let's go to 1 year. They're getting killed. This is what most of your money's in if you have retirement accounts. Okay, maybe Vanguard sucks. It doesn't, but let's just take that for a moment. Let's go back for 5 years. We're gonna do Fidelity, also a major player in retirement accounts, FFTWX. This is their 2025. See, just I don't know if you can see it. Fidelity Freedom 2025 Fund. I'm telling you that if you have retirement accounts, then that's what you have. I mean, it's terrible. And notice it went down in the pandemic every bit as much. Let's go to FFFEX. This is 2030.
So which funds do you suggest that?
Not these.
That mimic the S&P.
Well, you could get the Vanguard S&P fund, but I don't think the S&P is going to be anything to write home about going forward.
Okay, but it would have done better.
Oh, yeah, we've been just fine. Most brokers don't want you to do that. There's no fees in that. Okay, now let's go to FFTHX. This is a 2035. Again, what did the diversification do? They're all the same. I mean, this is nonsense. It's just nonsense. It actually just irritates the daylights out of me. Okay, let's go to the last one, FFFF, 4 Fs and an X for 2040. Same. Let's go to 2 years. Let's go to 1 year. Let's go to 6 months. I mean, really, you got to change it. A picture's worth a billion words here. This isn't going to work. It hasn't worked. It ain't going to work. What works? If you're going to buy stocks, you have access to the Vanguard S&P 500. I wouldn't be doing that here and now. I would be doing more like mid-cap blue chip, really blue chip stuff. But who is the mid-cap blue chip king in the world? Warren Buffett. Put up Berkshire Hathaway. Why not buy a stock run by the best investment advisor in our lifetime? Maybe in anybody's lifetime. Look at him in the last year.
And he's not even beating the S&P.
No, nobody beats the S&P. That's all right. But he's much more conservative. But let's look at the last year.
Hold on, let me.
Be okay.
Okay, so that's the 5 years.
5 years, he beat the S&P by a little bit.
Well, just a couple of
Yeah.
years.
Yeah, I don't care about that. It's a lot less risk. Let's go, because it's managed money. Let's go to 2 years. We beat it a little bit. Let's go to 1 year. Beat it by a lot. Let's go to 6 months. Crushed it. Better suited for today's environment. Right? I mean, he matched it in their best environment and beat the daylights out of it in his environment. Now, go back to BRK. Just erase that and put it back.
Back to BR.
BRK, yeah. I want to show you something. There's a B fund and an A. Go back to it. No, not the chart, just the sign.
Oh, okay.
Just put it up. Yeah.
Yeah, BRK.
Okay. There's a B fund and an A fund. The A fund sells for like $300,000 a share. You're not gonna buy that. That's for institutions. A lot of people don't realize there's a B fund, which is a clone, but it's like $300 a share. You can afford it.
Yeah.
Okay, so put those two up for 1 year. Put the A and put the B, and you'll see they're clones. So you can get all the performance at an affordable price. A lot of people think you can't do that. About a year ago, I told my brother's daughter, my niece, buy this. He said, my God, she don't have that kind of money. He was thinking 300 grand. So it's like, really, my own brother? How dumb can you be? But anyway. So you can see the top chart is the A and the B. They're clones, right? So buy that, buy annuities. I think you should always have some money in innovation and technology. But right now they're getting killed, but they'll be back. I mean, you know, we live on the pillars of our economy are innovation and technology. So they'll come back. I think you can take a rest here, but they'll come back. And you'll get another cycle. But you want to buy real blue chip stuff. And I don't give a damn about dividends and all that. Everybody thinks, well, dividend stocks will come through. No, they won't. That dividend stocks will do every bit as poorly as the S&P. That is not a formula for success. So I'm trying to encourage you to really evaluate what you're doing with your money. So let's talk about your money with what I titled this today. And if you have money in the world of investing, we would love to evaluate it, but if not us, somebody. Don't sit on your hands. The world is in shifting mode.
Mhm.
And I have not said that here, except for whenever I was here, January, February, for the last 30 years.
Well, for the benefit of those that are here, when Ray first spoke to our group, this is 10+ years ago, I think the rates had just dropped to 4%, 12-year. And the press, everybody was saying that we're in for hyperinflation, everything's gonna go up, interest rates going, everything's gonna go higher. And Ray's here, no, I think rates are gonna go down a little bit. And we all laughed. I mean, that was just craziness at the time. And sure enough, they went down, 3.5, 3.25.
But I would come every year and everybody wouldn't just laugh, they would actually protest.
Yeah.
He's like,
You-
no,
you-
I was
you had
actually
told us that
shocked.
a lot of times that rates were dropping and we just didn't believe it.
And now they're going up and you still don't believe it. People always believe what happened
Well,
last.
we believe you now.
Yeah.
Well, maybe this is the past couple months, yeah. But I'm telling you, we're in a shifting economy. You've got to come to grips with it. Okay, what questions might any of you have, if any? You all got this?
So what type of clients are you looking for? Are you looking, obviously you want the ones with millions of dollars, but will you take someone with 50,000 or $100,000?
Yeah, and we don't get clients with millions of dollars. I mean, not too many. We have some, but not too many. Our clientele is mom and pop, people who are, have some money. But if you're really, really rich, you need a banking relationship. So you have to do B of A or Wells Fargo or something like that, because you need a banking relationship. But ours is the middle and upper middle class. Generally speaking, not always, because we office in Beverly Hills. There are a lot of young people in Beverly Hills who have serious money, either because of the business they're in or inheritance or whatever. But for the most part, we're dealing with those who are either retired or contemplating it soon. Serious money. This is it. You can't screw it up. This is it. So it's got to be not the best returns, but the best returns compatible with prudence. And that's what I was saying. Buffett in recent year or so has beaten the S&P, but he was always close and more prudent. Always close, but more prudent. And that matters. And if you put a portfolio together properly, it should stand the test of time. Our portfolio has stood the test of quite a number of years, but we are now shifting and we think we're categorically on the right track to do so. So change, while it should be pretty infrequent if it's well designed to begin with, it is inevitable. Every once in a while, things change. But once you put a portfolio together correctly, leave the damn thing alone, be patient and be a long-termer. Right? Don't be overactive. It just costs money to be overactive. Okay, what other questions? Any?
That's what I remember. I was hearing that it's a long term that you make it, always encouraged to do it young and just
Right.
for later, right?
And let the great American economy take care of it. But every once in a while, you get seismic shifts, and I think we're in that. We're going from low inflation to high inflation. We're going from low debt to high debt. We're going from you can't get a worker. You just can't get a worker. We're going from a shortage of almost everything. And you see that in your business. There's no inventory.
But then again, it's the world. Today, for example, I was talking.
Whatever America does, there's an old adage in investing, when America sneezes, the rest of the world catches cold. We are it.
Yesterday in Canada, they, I think they put my friend that is a developer in Toronto, he called me today in the morning, he says, he was very surprised that they did pass this law that no foreign people cannot buy in Canada for the first 2 years.
Oh.
Yeah.
They have to be a resident for more than 2 years.
For more than 2 years, because that has driven the prices where they are at. He says Toronto is impossible. The median price of a home is 1.2.
Now, Canada is more socialistic than we are. I don't see that we would be able to pass it.
Yeah, but I agree. But what I mean is that I still believe that, like you said, this economy
It's changing.
even though it's changing, the world is changing.
Yeah.
So if we're going to go, like we say in Mexico, to somewhere that there's shade, I'll go to the biggest tree. The biggest tree is still that.
Well, absolutely. If you can't make money in a $50 trillion economy, sure as hell aren't gonna make any money in Taiwan. I mean, you know, we're the biggest economy the world's ever known. If you can't do it here, I don't know where you can. But at any rate, speaking of socialism, I've been telling everyone this story. It just boggles my mind. We do webinars with, in conjunction with Santa Monica College. We did a webinar a little less than a month ago called Women in Investing. I really like women because they will listen.
Well, you have them in real estate, you know, they're,
Yeah,
I hate making all these stereotypes that, but they do better in real estate.
do they do better? Yeah.
Residential stuff.
Yeah. Well, you know, I could see that. I mean, a lot of people, that's home and hearth and all. I mean, I could see it. But at any rate, so people then sign up online if they want an appointment, and usually it's a Zoom nowadays. I miss the in-person, but the Zoom is so much more convenient. I don't have to drive down here. So, but anyway, so this one woman wanted an appointment. She said, I don't have much money. Fine, you know, we're open. I got online with her. She's 63 years old. She married a guy 3 years ago, and she claims in order to get a spousal benefit on Social Security, because the spousal benefit was higher, and she was a heck, she never earned much money. She said that she and her husband had $5,000, 63 years old. I mean, that's scary. She lives on Medi-Cal. She gets what I call welfare check. She gets some kind of check from government. She lives in a rent control apartment in Santa Monica. And she's living on Social Security spousal benefit, which was, according to her, the purpose of the marriage. Okay. So she is living on the dole. Right? And then somehow in the middle of this conversation, she says, all the morons who voted for Biden. I don't know your politics, I don't want to give a damn. But anyhow, I said, well, I got to tell you, I'm one of those morons. She said, well, he's nothing but a socialist. I said, really? That's what you live on. If you really think he's a socialist, you should be applauding him. I mean, otherwise you're dead meat. I was blown away by that statement. Just blown away. Medi-Cal, rent control, fraudulent Social Security, essentially. I mean, just, you know, maybe, and get some sort of a government check. I don't know what, welfare or whatever you call it. I mean, and she's outraged by socialism. It's like people are nuts. She should be applauding it, if anything, right? What do you think?
I agree.
And yeah, I love telling that story because it just tells you how out of touch people are with their own situation. I gave up. Okay.
Well, it works both ways. The owner of this whole center here, Fitzpatrick, he passed away years ago. He was in his 90s, known him forever. He was in a Rotary Club, and he was probably the only very liberal person and probably one of the most wealthiest, right? And so when it didn't make sense to me, just like
Right.
this lady,
Right.
because when we were golfing or personally, he would always complain that, you know, taxes are too high and that there's too much. And I'm looking at him and you know, this is the most liberal guy I know. Man. It's,
Right.
just doesn't make sense.
Right. Well, and you know, our taxes are among the lowest in the world. And along those same lines, we went up to see my grandkids in Berkeley about 3 weeks ago, so recently. And my wife's oldest friend, they went to grad school at UCLA, was up there. So we always invite her to dinners with the family because we like to see her. And she's very liberal. And I thought it was kind of interesting. She's very unhappy about taxes. But here's the thing, she wouldn't even pay it. I mean, it's mind-boggling. She paid about $1,500 a year. I mean, it's like, really? And, you know, you see that on a larger scale. The state of West Virginia, the state of Georgia, the state of Mississippi are always aggravated about, you know, don't help New York. But I don't know if you remember in the 70s, New York was going broke and they petitioned the government, federal government, for funds, and Gerald Ford, the headline was "Drop Dead." I don't know if you remember that. But what people don't realize is California, Illinois, New York, they support those states. There's more money. California, we send more money to the federal government than they send back. Mississippi, they receive more money than they send back. West Virginia, they receive more money than they send back. They should love the government because it bails them out. They should love New York because they bail them out. It is interesting how people lose sight of what really sometimes is in their own best interest. It's strange, but you gotta love them. It's what makes it. It's a great country.
Keeps us
It's
employed.
great to be an American. Okay, we need record of attendance when we give a public talk. So if you would please fill these out, I would very much appreciate it. And if any of you would like an appointment to discuss your own situation, I would even like you to do that.
Thank you.
Sorry, well, it's like,
And there you go.
I don't want to lose my place. Is there another one?
Yeah.
Okay.
You know, I'm sorry. Oh, it's okay.
See, I knew I could.
Thank
count
you.
on that.
Sorry, thank you.
I knew I could count that.